Yeah, good evening, traders, and welcome to this other series, of our learning experience with Amam Broking Services. So where we had left off, we had looked at technical analysis. But we didn't dive deeper into technical analysis. So what we're coming out here for today is for you to have a glimpse of what technical analysis and maybe dive a little bit deeper into the whole concept. So in this case, I may not necessarily consider everyone that's particularly watching this video as a beginner, because you guys have kind of like elevated from that part where you were absolute beginners and you're now, or you could now be regarded as people that are slightly going into the intermediate stage. So from what we had covered, just a recap, we said technical analysts believe prices move in trends, and as such, their goal is to identify the existing trend and follow it. So this principle originates from the Dow theory. The three main trends of price action are up, down, and range. So we are saying that the market is either in an uptrend, a downtrend, or a sideways trend. Understand? If you can look at this, then I marked up this just for illustration purposes. So what we are trying to see out here is that if someone gets to identify all key levels of price, it can literally be in position to help them get to identify the existing trend. From what you can see, we have like a level around here. You could see that price came into this area and bounced off it. So you consider this as maybe a key area of price to look out for. So if that's our key area of price to look out for, what are we going to do? We're going to have this sort of thing, identifying that trend. Price goes up, but then fails and comes back down. So as it comes back down, we had a low point that price breaks, then retests or goes back to the upside to create some sort of a high, then drops down again, pushes to the upside. We could look at this high, then it drops down again. You understand? So it continues doing the same thing. So with this, someone can get to identify and understand that this price is in some sort of like a downtrend. Because as price keeps on moving, it reaches within certain key areas of price, breaks them, and then continues to the downside. So in this case, what you're doing is you're identifying a specific trend and follow it. If that trend decides to change, then you also get to change. Let's say, for instance, price has been breaking while going to the downside, but in this case, breaks and goes above to the upside. It's now breaking, going to the upside. We'll now be identifying this trend as an uptrend, so we'll want to follow it in position to make money. So that's literally what technical analysts be doing. So what we're trying to say here in regards to technical analysis is that price and history definitely repeats itself. Okay, so here we are saying another basic premise of technical analysis is that investor behavior tends to repeat itself over a period of time. Investor behavior is any participant within the market. What they most probably did before, in most cases they're going to be doing in the future. Whichever way price happened before, in most cases, it's going to be the same thing. The price is going to be happening in the future or in this sort of like current market condition. How it's going to react here will be influenced by how price reacted this side. So as a technical analyst, you understand that history repeats itself. All you have to do is go back and test and study and understand how price behaved previously. Then once you're in position to do that, you can always come back up this side and get to know, identify how price is going to behave in the current market condition or the future, using that knowledge that you had from studying the past. So to proceed, okay, technical analysis believes that this behavior will create identifiable price patterns on a chart which can be studied to predict similar chart prices. That's something that I've tried to sort of like explain. So what are some of the charts that we get to look into within technical analysis? We look at what we call a bar chart, we look at what we call a line chart, what we call a candlestick chart. Okay. So what are those? So maybe starting off with a bar chart, whatever bar chart is. So we say this chart type is made up of vertical bars, each showing the open, close, high, and low prices. Each vertical bar represents the range of each time period. The top of the vertical bar indicates the highest price, while the bottom of the bar represents the lowest price at that particular point in time. The opening price is shown by the tick to the left of the bar, and the closing price is the tick on the right. Okay. So if we have a specific candlestick, we could choose which one specifically. We could say we get to choose maybe this one right here. So it has a tick to the left, a tick to the right. Okay, so we are saying that tick this side is the one that closes, the tick this side is the one that opens. Then these candlesticks also have high and low points. Okay, so the bars are vertical, then it has an open and it has a close as well. Then it also has a high point and a low point. Okay, so bar charts are not necessarily used a lot within trading because as technical analysts, the best forms of charts to use to do technical analysis or marking up chart, market structure, price action, all those things. In most cases, you always need to be having a candlestick chart and we'll be looking at it as we dive down. Okay, so that's an illustration of a bar chart. Okay, so as we proceed, we get to look at a line chart. So a line chart is actually a proper representation of key price points in price. But let's get to look at it and what it literally entails. So say the line chart connects all the closing prices with a line, which shows a lot of information regarding price. From this type of chart, we can note the open, close, high, and low prices, just like in a bar chart. The difference between a candlestick chart and a bar chart is that visually, candlestick charts are easier to use when trading and performing technical analysis. Okay, so when you come and look at this, this is now a representation of a line chart. You know, usually what we use line charts for in trading, let's say professionally, if I may, is in most cases is to help us get to identify key price points. For instance, if I have this as my resistance area of price, if I have this as my resistance area of price, I want to identify the exact point, you know, because we have candlestick wicks. These are the wicks. This area here is a wick. This is also a wick. We have this wick. But now I want to focus on real actual price action. So how am I going to be in position to do that? Always come out here and look for my line chart. So when I get to see my line chart, I can now drop a line on the key price points. I can have this, then I also have this. If I bring back my candlestick chart, you're going to see the price slightly protrudes through a specific price point. You know, we have price extending without the upside. We have price extending to the upside, extending to the upside. But our key price point in this regard is this, and it is usually a representation of candlestick closure, because we're going to be looking into it. So when we proceed, you're going to look at a candlestick chart. Okay, so what I'm trying to say is that the difference between a candlestick chart and a bar chart is that visually, candlestick charts are easier to use when trading and performing technical analysis. This is something I've explained previously. The reason is because candlesticks are good at identifying market turning points. Okay, we're able to identify swing high and swing lows. For example, they show reversals from an uptrend to a downtrend or downtrend to an uptrend. This is literally a representation of what we term as a candlestick chart. Okay, this is a representation of a candlestick chart. Okay, so if we proceed now to dive down into the candles or the candlesticks, okay, looking at the anatomy of candlesticks. Okay, so with anatomy of candlesticks, we're trying to say that these candlesticks are Japanese candlesticks literally. So Japanese candlesticks are formed using the open, low, and close of a chosen time frame. You understand? So we could have an example like around here, let's say. So we have these two candlesticks. This one is representing a bullish candlestick. It has an open to the low. It has a low point. It pushes to the upside. It gets to make this high. Then it finally comes and closes here. So this is the real body of the candlestick. But the actual full movement of price is that price extended to this low and extended to this high in the upper shadow and lower shadow. But that is not the real body. The real body is this overall enclosure of price. Similarly, the bearish candlestick is being denoted by black color. So this is the entire real body, but we can see the region within which the candlestick reached. We have its utmost high, then we also have its utmost low, being represented by the upper shadow and the lower shadow. Then it also has an open. Since it's bearish, it opens from above, so that down to it opens from above, pushes up to create a high, then drops all the way down to create a low and comes and closes within that trigger. I can illustrate that out here again. So we're looking at this candlestick now. For instance, the one we have, the current one. So right now where price is, we have this candlestick having opened from this specific point. Okay, so it could be from this point. So it opened from this point, it pushed up to create this as its recent high. So that was its high. So it dropped all the way back down to create a low, and it had pushed back up into this region. It now hasn't closed. So if we look at the previous one, this very candlestick is our previous one. So we could say that this above, since it's bearish, the other side the bearish one is noted by a black color. In this case, this is a red color. So this is bearish, okay? It opened from here, then pushed up to create a high point around here. Drop it the way back down to create a low point here, okay? And then it finally came and closed at this area. So this area where it closed from, that's where the next one opened from. So you can see where the next one opened from. It opened from this exact area, pushed up to create a high, dropped down to create a low point. Now it has squeezed and it's still playing around here. However much it hasn't yet really closed. Okay. These are 4-hour candlestick. It's going to take about 4 hours for this candle to close. All right. So if we proceed from that, having understood the overall anatomy of the candlestick, how it gets to open, how it gets to close, I would urge you to do a little bit of more research. If you're kind of like not really getting most of these things, to us, some of these things actually look basic, but if someone is actually starting, they can be a little bit daunting, they can be a little bit confusing. So you might feel like you're out of place, things are really hard, but they're entirely not hard. Okay. So here I'm trying to further explain that a white candle in this picture or in this image above, okay, it's a white candle, this is a black candle. So what I'm trying to say down here is a white candle means that the closing price was higher than the opening price during that time period represented by the candle. Okay, that is why the candlestick is bullish. Okay, the closing price is higher than the opening price, as you can see. Its opening price is below, the closing price is above. So saying that the opening price is literally lower than the closing price. So the closing price is higher than the opening price during the time period represented by the candle. Then the black candle is literally the opposite. Okay, it shows that the opposite, meaning the closing price was lower than the opening price. If you can come and see this, its closing price is below, its opening price is above, which is quite opposite to this. With this, the closing price is above the opening price. With this, the opening price is higher than the closing price. So just a little bit of things to help you understand, but they might actually look like they're confusing, but they're literally not. Very easy stuff. So the shadow on top of the body of the candle represents the highest price traded during that time period, and the shadow below the candle represents the lowest price. Okay, those are the high and low points that I was trying to talk about. Each and every candlestick has a high and low point. Okay, so a low point, it's a high point. So low point, it's a high point. It might actually be the same, but the opening and closing prices are different. Okay, yeah. Just during that time period, and the shadow below the candlestick represents the lowest price. Of course, today, using technology and online trading platforms, it's possible to have different colors for the candlesticks. You can always come and change. So here I might be having maybe green and red. Someone else might want to prefer to have another color. We could always come and try to change it out here. You could say instead of green, you want to have red and blue. Okay, come and change it to red and blue. It's a preference. Okay, if you're a girl, you could say you want to have maybe instead of red, you have like pink. It's it's all a preference. If you're a guy, hard guy, then you might have maybe red and blue. Okay, okay, come back here, red and blue, red and blue. Okay, you might choose to have charts like that. So it depends on someone's entire preference. If you want to have it in black, you can always come and change it to that black color that you want. So to further proceed, So here we're having a brief introduction to technical analysis. It may have seemed like we had already dived into technical analysis, but there's a little bit um, more aspects that you have to get to look into to critically get to understand technical analysis. Okay. So in technical analysis, we have what we call trends. So a trend is a direction to which the market is moving. We have three types of trends. We have an uptrend, that is when the market is moving up. It's defined as a series of higher highs and higher lows. Okay. We always get to find a new high being created, the previous one. A new low created is higher than the previous low. Obviously, you understand that in the picture that I'll attach. So we have something like here. Okay, but let me try to go and illustrate this so that you can clearly get to understand it. So what we have is something like this. We're saying if it's an uptrend, price makes a series of higher highs and higher lows. Okay, more like market structure. So what we have out here is we have a starting point of price. You don't necessarily consider so price starts from here. This could be the pivot point of price. It pushes up to create. This is our high. Okay, this is our high or high point of price. Then price drops down to create a low point. Okay, as it creates this point, it now pushes up to the upside to create what we call. It creates this higher high. Why is it a higher high? It's higher than this previous high. You could see, but at the same level, this high is way below than this high. So that makes it a higher high. So still, even after this higher high is formed, price will now drop down to create what we call a higher low. So this is a low, could have higher low. So price comes and creates a higher low. We proceed to the upside. Okay, so when we proceed to the upside, the market will still come back again and make what we call a higher and create what we call a higher high, right? Still, after creating that high, price will have to dive back down a little to create this higher low. So this is a higher low formed by price, meaning price is still in an uptrend. This will continue up until a point in time when price, like this is our previous higher high, and now price after forming this low was to push to the upside and create another higher high so that we can continue. So if price fails to break the previous higher high and instead reaches down there and starts to have signs of dropping to the downside, or even maybe break the previous higher low to create a lower low, because now this is a higher low, but now since price drops down here, it's now creating some sort of like a lower low. So if it creates this lower low, to push to the upside still to create a lower high, it's a lower low, lower high, lower low, lower high, lower low, lower high, lower low, until when price, after creating another lower high to continue to the downside to create another lower low, it fails to, comes to this point, gets rejected, and now starts creating a series of lower highs and lower lows, lower highs and lower lows. So that is the overall explanation of the trends. So you're seeing an uptrend, that is when the market is moving up. It's defined as a series of higher highs and higher lows. A new high created is higher than the previous one. Okay, this is what we're trying to say. If this is a new high that has been created, it's higher than this previous one. Okay, a new low created is higher than the previous low. Same thing. We had a low here, a new low was created, it's higher than the previous low. So this is an explanation and understanding that the market is still in an uptrend. Similarly, when you get to look at the one for a downtrend, it's the same thing. So we're trying to say that a downtrend, that is when the market is moving downwards, is defined as a series of lower highs and lower lows. A new low created is lower than the previous low, and a new high created is lower than the previous high. So all the lows you're seeing, this is a new low created, is lower than the previous low. So this gets to be our lower low. Okay, after creating that lower low, price pushes to the upside to create now our lower high. Why is it a lower high? It's a lower high because it is lower than the previous high. In this case, this was our high. As price was pushing to the upside, we can't call this a higher high. Why? It is not higher than our previous high. So this is just a a high point of price. It being a high point of price, price dives down, to create a low, which is lower than the previous low, pushes up to create a lower high, comes back down, creates a lower low. The same thing continues time and again, time and again, till at this point we have failed to break. This will be our very last lower low down here. So price fails to break it, then you proceed to the upside. So generally that's how the market moves. That's a concept called market structure, but we'll be diving into it as we proceed. Then we have what we call a sideways market, which when the market is moving horizontally, when it's trending up, we buy the market or we go long. Okay, so for the sideways market, we have a market that's behaving in this kind of manner. It's not going up and neither is it going down, but it is not stagnant. It's moving. Okay, we have it bounce to the upside, bounce to the downside, bounce to the upside, bounce to the downside, bounce to the upside, bounce to the downside, bounce to the upside, bounce to the downside. So this is what you have as our sideways market or our sideways trend. Okay, this is our sideways trend or our sideways market, or some people can tend to regard it as a consolidation. So it's a consolidation or sideways market, a sideways trend, consolidating market, whatever you choose to call it. So if we proceed, just a few more understanding within that overall concept of technical analysis. So we do have a bullish market, the kind of market that's trending up. When it's trending down, we sell the market or we go short. Then we have a bearish market trending down. So the bearish market that's trending down, we get to sell. The bullish market that's trending up, we get to buy. We do not trade the sideways market, but other traders do. It only comes with experience. Now, with this, it depends on the time frame that you're on. We'll be diving into time frames. You'll be hearing a lot of things regarding the time frames, and you'll be picking up a lot of stuff within that regard. What I'm trying to explain further is that whenever you're always trading, okay, you should usually, it depends on the time frame. If the time frame is high, you can go ahead and trade these choppy consolidating markets. But in most cases, what we want are the impulsive moves, okay, or the moves that have a potential to give us a higher reward or more profit, So we'll be taking this trade over to the downside. Similarly, if we have a trade moves to the upside, something like that, those are the moves we want, as opposed to the moves that are always going to be ranging with this sort of price. Okay. So if we proceed, this is just an illustration to show you what we're trying to talk about. So this is a representation of an uptrend, it's a representation of a sideways trend or consolidating market, and this is a representation of a downtrend. Okay. So guys, as we come back into the next video, we're going to be diving into a few more concepts to get to understand within technical analysis. We'll be diving deep down into the chart, seeing most of these things from the visual expressions that I've been trying to use. You get to a market like this, get to identify, how do you get to incorporating technical analysis? How do I get to identify all those areas? If someone says they studied price from before, am I going to be positioned to utilize that and be positioned to kind of like make money? You get to look at patterns, all those other things as time goes. Yeah, so thank you for watching this video, and don't forget to subscribe, click on the like button. You could put your concerns in the comment section, and you get to see how we could possibly get to help you. So thank you, and see you in the next video.